Good afternoon. Let's start our second session on new perspectives on the transmission mechanism of global liquidity. Dr. Fritz Zurbuch, a member of the governing board of the Swiss National Bank, will moderate the session. Dr. Zurbuch, the floor is yours.
Thank you very much, ladies and gentlemen. So after having defined the terminology and our definitions, we're moving into the transmission and management of capital account. We have a very distinguished panel, our two speakers to my left and Simon and Olivier as discussants. And as the governor said last night, we're also here to have an open discussion with distinguished members out in the audience. So we'll try to see if we can stick to the organizers' time limits, 20 minutes for the presentations and 10 so that we should get some time in for questions. So, Bob, thank you very much.
Thank you, Fritz, for that introduction. A Korean friend once told me that Americans start with a joke and Japanese start with an apology. So let me do it Japanese style and apologize to you that only now are you getting the paper. The excuse that Dong He, my co-author, and I might offer is that we took the question from the Bank of Korea, whom I thank very much for the invitation, took the question from Barry Eichengreen to talk about the transmission of global liquidity. We redefined it as the transmission of very accommodative monetary policy in the key currency countries, but we are going to present you with some new work on the subject. I should say at the outset, of course, that these views are those of myself, my co-author, and not necessarily the Bank for International Settlements or the Hong Kong Monetary Authority. So we're going to divide this transmission into 5 different channels, partly overlapping. The first 3 are price channels. The second 2 are quantity channels. First of all, often overlooked, the central bank reaction function. Central banks in emerging markets respond to very low interest rates in the major currencies by setting their interest rates, their policy interest rates, lower than they might otherwise do. Second is the direct transmission of lower bond yields as major central banks buy bonds in their own domestic markets. The effect of that in terms of lower bond yields diffuses broadly to markets that are linked through substitution. There is the third channel, which is very low rates at the short end. At the long end, tend to put upward pressure on the currencies of emerging markets. Now on to the quantity channel. There's first of all a direct effect of lower interest rates in key currencies to the extent that companies in countries outside the key currencies have borrowed in those currencies, so foreign borrowing is made more cheaply. Monetary conditions are eased immediately with lower interest rates on major currencies. In addition, companies are induced to shift some of their liabilities into the major currencies, especially in the presence of expectations of appreciation of the domestic currency. And finally, capital flows into local currency, bond, and equity markets. So debate is often focused on the currency angle. On the capital flows angle, we'll have nothing to say about the capital flows. And I'll try to be brief on the first 3. This is in the way of a review of the literature with our original contribution for you to judge on the 4th point of the foreign currency borrowing. So to give you a preview of the points to be made under that 4th point, dollar credit, foreign currency credit, low interest rates make for lower cost of servicing extant debt, and to the extent that there are currency expectations of appreciation of the domestic currency, there's an additional incentive to move liabilities into foreign currencies. Now, it's important to recognize that there's no mechanical relationship between what's called quantitative easing and lending in foreign currency. That can be done out of local deposits, or it can be used, or cross-border funding can be used. We'll see that that differs across the countries to be examined. The nationality composition of international banking makes a difference. In the most recent period, we've had a deleveraging by European banks, and since they were very well represented in dollar lending in this part of the world, that's had an effect of actually holding back the foreign currency lending. And I think a key finding is that policy in the region has leaned against the incentives to borrow in foreign currency by, in effect, making the foreign currency debt more expensive. And this is done through capital controls in the mainland of China, but it's done through macroprudential policy here in Korea. So let me briefly go through the central bank reaction function. If we take the Taylor rule as kind of a prescription, you can see that in the first half of the sample period, emerging market economies more or less followed Taylor rule type policies, standard parameters, but then departed from it in the lead up to the crisis and then since the crisis. So if you take that as a benchmark, you could argue that policy interest rates have been systematically set lower than they might have, in part in reaction to the global events, the very low interest rates in the advanced economies. Motivation, among others, to keep the pressure on the currency from being as much as it might be with a wider spread at the short end. There have also been estimates of so-called open economy Taylor rules, in which the federal funds rate enters as a right-hand side variable. These are Spencer of Deutsche Bank's estimates of how big the reaction of central banks in setting their own policy rates has been over the past 10, 13 years for these economies, ranging from nothing for the People's Bank to up to half or more for the Philippine Central Bank. So you don't have to buy those numbers or the Taylor rule estimates that I just showed you, but at least I'd like you to entertain the possibility that it could be a major transmission channel that central banks systematically set their policy rates lower in response to very rock bottom rates in major currencies. Now let's turn to the bond market, go farther out the yield curve, and what has been going on in the major bond markets is an attempt by the central banks to lower longer-term yields through large-scale bond purchases. Already back in 2003, 2004, the data suggested that the Ministry of Finance's purchases of U.S. Treasuries, studied by Bernanke et al., had a broader effect on other markets. That's on the left-hand side of this chart, a $1 trillion purchase of dollars by the Japanese authorities was worth something like 10 basis points on the U.S. Treasury 10-year, generally something like half of that in other major bond markets, Britain, Germany, France, even Japan. Turning to the large-scale bond purchases proper, Neely found that there was a systematic compression of yields in bond markets in the rest of the world. Follow-up work with Bauer suggested that most of that came from suppressing term premia. So that's on the right-hand side of this graph. And finally, there's a work by Chen et al., which suggested that emerging market bond markets as well benefited from the downward pressure on bond yields, particularly in the first round of Federal Reserve bond buying. So the upshot here is that bond markets, things don't stop in the market that the major central banks intervene in. Those markets are part of a global bond market. If you take duration out of one market, duration will be sought in another market, and the effect of the purchases will diffuse broadly, not one for one, but to a considerable extent. Finally, the exchange rate transmission. Here the question has to be asked because of some popular economics, popular models out there. Should we think of this as a quantity or a price effect? In Tokyo, the Soros graph is an object of much comment, which shows the change in the relative size of the monetary base of Japan and the United States against the change in the dollar yen. That is very suggestive. So that's on the right-hand side of this graph, the sort of stock version of that, if you will. The red line shows you the Bank of Japan assets in relation to Japanese GDP divided by the Federal Reserve's assets in relation to U.S. GDP, and you see a broad consistency there, which hasn't been doing so well lately. Professor Ueda at the University of Tokyo argues that it's really a few monthly observations in late 2008 that really makes that so-called Soros graph. But a glance at the ECB versus the Fed will suggest to you that this is not to be taken too seriously. Indeed, while the dollar was depreciating against the yen in late 2008 on the back of, some would say, the large expansion of the Federal Reserve's balance sheet, it was simultaneously appreciating against the euro. So just a huge inconsistency for that hypothesis in 2008 with respect to the ECB and Fed balance sheets. And again, more recently, the data are not coming in to favor this view. So one does better being a little more conventional, I think, looking at bond yield differentials. The 2-year note, Japan, U.S., JGB, U.S. Treasury is on the left-hand side there. Again, fell apart late last year. One could even try with ratios on the right-hand side of the 5-year rates, and that worked for a little bit before falling apart. Just another victim of the volatility of JGB yields. Of course, it's not only through the exchange, well, I should say the exchange rate pressure is one thing, the exchange rate movement is another. This chart is here to remind us that the central banks in this part of the world take a good bit of the exchange market pressure in the form of reserve accumulation. So the upshot of that, if you put together number one and number two, that your emerging market central banks may hold down their policy rates, that their bond yields may be pushed down by the large-scale bond purchases, then that would suggest that the measure of the effect of the accommodating monetary policy is not to be measured in the currency movements, the extent of appreciation, to the extent that the short rates are kept low, to the extent that the medium-term rates are lower as a result of the diffused effect of bond market purchases by the major central banks, then there's really less for the exchange rate to do, and the exchange rate change cannot be a summary measure. And even more when you think that a lot of the exchange rate pressure was resisted. So that brings me to the transmission through foreign currency credit. And it's important to recognize again that dollar loans can be funded with local deposits or mostly with cross-border interbank borrowing, and we'll see China is different from Korea in that regard. The summary statement for China has been there's extremely rapid growth of foreign currency loans in China, though it remains foreign currency credit only a single-digit share of bank credit there. Capital controls there mean that the authorities are able to reprice dollars, as it were, on entry, and I'll show you evidence that interest rates on dollars in China are considerably above global levels. VAR analysis of monthly changes in the Chinese data show the effect of currency expectations. When the RMB is expected to appreciate, there's more demand for foreign currency loans. It also, those loans are also responsive to local interest rates, higher RMB policy rates mean a faster foreign currency loan growth, and they're also responsive to the local dollar rates. I'll skip Hong Kong, and for Korea, just a preview, very different experience there since the crisis as compared to China, but basically very stable stock of foreign currency loans, even on a very expansive definition, which I will propose. And so the question is, why is there that difference, rapid growth of foreign currency, mostly dollar credit in China, very limited growth in Korea in the post-crisis period? Let me skip this, just take my word for it that there has been a headwind in this foreign currency lending in this part of the world, represented by the fact that the European banks have deleveraged and gotten out of the business of intermediating dollars in the region. So if you think of that, that's a kind of friction on the supply side of foreign currency credit. So the growth we're seeing in China is notwithstanding that, and the lack of growth we're seeing in Korea could be partly explained by that friction. So let's go to China first. I'll skip Hong Kong, so we'll do just China and Korea. What you see on the left-hand side there is that foreign currency loans in and to China growing very rapidly, up to $800+ billion in the most recent data. Most of that is dollar or foreign currency loans booked at banks in China. Some of it, the blue area, is cross-border BIS bank-reported cross-border claims on non-banks in China. If we take that as a share, it's not a very big share. It's up to 8.5% of all the loans in the Chinese banking system. If you think of the export exposure of the Chinese corporate sector, it's very hard to think of that as a case of currency mismatch, at least in the aggregate. So we're really not talking, and I would suggest the same is true of Korea, we're really not talking necessarily about currency mismatches, rather financial stability questions having to do with funding and the liability maturity and so on. So where did the money come from that those Chinese banks are lending? Where did that foreign currency come from? Well, up through 2005, 2006, the loan-to-deposit ratio in China was less than 100, meaning that the banks there were at most lending out the foreign currency deposits they had from companies and households in China. Since the unpegging of the RMB in mid-2005, you've seen that loan-to-deposit ratio go up well over 100%. Where's the money coming from in that case? Well, on the right-hand side, the graph there shows you the gap between Forex loans and deposits in China is the red line, and the blue line is BIS bank claims on banks in China. So very broadly, kind of squinting at that chart, the money comes in as an interbank flow to fund the difference between foreign currency loans and deposits. So in that sense, China is similar to Korea. It's different, however, in that the authorities in China give each bank in the country a sort of quota of how much foreign currency it can bring in each year and moves that quota around in response to conditions. The result of that is that interest rates on dollar loans in China can be noticeably higher than sort of the global dollar LIBOR, whatever you think of LIBOR. The gap between the blue line, the fixed rate for lending US dollars in the mainland, and that 12-month LIBOR can be very wide. And so essentially that reflects the constraints that the Chinese authorities have placed on banks bringing in dollars to fund the difference between dollar loans and deposits. So if we do a VAR analysis on the monthly data from January 2003 to December 12, in the third sort of box there, you see the policy interest rates. That's higher interest rates in RMB lead to more foreign currency loans in China. And if the RMB is expected to appreciate more in the lower left-hand box there, we get a sizable and immediate response of foreign currency borrowing in China. And if that interest rate I just showed you in China, the sort of Sino-dollar interest rate goes up, it tends to reduce the growth of foreign currency lending in China. So these all make sense. Let me skip Hong Kong. Now you've all seen, all the Koreans in the room have seen graphs like this. The essence of it is that a Korean company on the left-hand side there wants to nail down, wants to secure a certain dollar-won exchange rate in the future, and it does that through a forward transaction. And the key result of that is, or can be, a larger stock of short-term claims on Korea booked by foreign banks. Essentially, they take the forward position and offset it with a long won spot position, and the liability associated with that shows up on the Korean balance sheet. You might say shows up on the Korean international balance sheet as kind of a pollution item, because the short-term debt, as has been argued, is quite flighty. So with that thought in mind, I'm going to ask you to allow me to aggregate not only the familiar bit in the bottom of this left-hand chart from China, that is the Forex loans of banks in Korea, and then the blue bit, which is the cross-border loans to Korean non-banks that are reported through to the BIS. But on top of that, I'm adding the net won assets, the extent of holdings of KTBs or Bank of Korea monetary stabilization bonds by foreign banks in excess of any won liabilities. And I want you, under the argument of the previous chart, to accept that as, in effect, dollar credit to the corporate sector in Korea, so that the real measure of foreign currency borrowing in Korea is the sum of the red, the blue, and the yellow. And so as a share of total loans on the right-hand side, you can see that came down after the Asian financial crisis, went back up through 2008, and then has come back down. So the blue line at the bottom is just the red and the blue bits on the left-hand chart, while the red line includes that yellow area on the left-hand side. So again, I would suggest that there's no prima facie evidence here of a currency mismatch. If you think of Korea as having, I don't know, 40% of GDP exports, and so that's an even higher share of value added in the corporate sector, it's not at all obvious that having 10 or 15 or even 20% of the bank debt of the Korean enterprise sector is a currency mismatch in any reasonable sense of the term. However, there is that little problem of the pollution on the international balance sheet of Korea, and here the comparison with China is very clear. The loan-to-deposit ratio, either the standard one or my augmented one, for foreign currency lending, banks in Korea is very high. The banks in Korea don't have much in the way of foreign currency deposits to lend out to the corporate sector. So what that means is the gap between loans and deposits in foreign currency, the red line on the limited definition, the blue line on the right-hand side on my more expansive definition, basically tracks the cross-border, the solid red line below is the narrow definition, the dotted red line is the broader definition of foreign currency loans less deposits in Korea. And you can see that tracks the blue line, which is the cross-border claims, the advances by foreign bank affiliates outside of Korea to their branches in Korea, by and large. So just as we saw in China that the local dollar interest rate was above that obtaining in the rest of the world, so too in Korea we observe that the cost of dollars is not just the red line, 3-month US dollar LIBOR in Korea, but rather the blue line, where the difference is the basis swap. You could use other measures of sort of deviation from covered interest parity, if you will, in Korea. But essentially, dollars are more expensive in Korea than they are in Singapore or London, and you can see by a considerable measure. And obviously, even in dollar-euro these days, there's still some deviation, some basis there. So it's hard to say this is all due to local policy, but certainly the macroprudential policies of the levy on short-term liabilities and the limit on the forward positions of foreign bank branches in the U.S. has to be given some credit. So the macroprudential measures show up in more expensive dollars in Korea, which has resulted in there being less in the way of cross-border interbank liabilities of Korea to the rest of the world. Is that because currency expectations have been hugely different in China versus Korea? This suggests the consensus forecast for what they're worth suggests not. And moreover, there's an interesting observation from the international bond market, which is that the Korean corporate sector is borrowing very heavily there. So we have the contrast then between, on the one side, the Korean corporate sector through the banking channels has a very stable foreign currency debt and declining in relative terms. Whereas in the international bond market, Korean firms are stepping right up to the plate and borrowing apace. Now, one view of that would be, I suppose, that this is just regulatory arbitrage, that the Korean corporate sector is playing the same game that the foreign bank branches used to play. But I would suggest a more benign interpretation, that to the extent that these bonds being sold by the Korean corporate sector are for 3 or 5 years, that the basic problem, which was the currency mismatch or the short-term nature of the Korean liabilities in dollars to the world banking system, that has gone away. It's been replaced with term lending by the corporate sector. So in a certain sense, I would suggest the interpretation that the policy, to the extent it has produced this result, has worked precisely to get the corporate sector in Korea to internalize the costs of the sort of pollution that we saw before the global financial crisis. So to conclude, this transmission of global liquidity or accommodating monetary policy to East Asia takes a manifold of channels, prices and quantities. And it's important to recognize that the growth of foreign currency credit does not depend in any mechanical sense on outflows from the source countries. Foreign currency credit to firms in mainland China and to their affiliates in Hong Kong growing very rapidly, whereas this foreign currency bank lending in Korea has been very stable since the since the global financial crisis, rather. So one interpretation of that, I have suggested the macroprudential measures. One also has to recognize an alternative hypothesis, which is the retreat of the European banks has made it systematically more difficult to intermediate dollars to this part of the world, whereas there's no such supply side problem in the global bond markets, arguably the opposite. So I thank you.
Thank you very much, Bob. Simon's already at the microphone. Excellent.
Okay. Thanks. Thanks for inviting me to discuss this paper. It's well worth a read if there are copies of it. I might be the only person in the world that has a copy. Has it been distributed? Yeah. So I'm going to try and summarize the paper, talk a little bit about this from a US perspective, see if I can take some of the theory from the morning and relate it to what we have just seen, which has got a lot of detail about how the financial system works in Asia. So I'm going to give you an overview. I'm going to go through central bank balance sheet expansion, called QE, price and quantity. I'm going to take an old-fashioned view of what quantity is. Not surprisingly, I'm going to say price is a dominant effect. Then we're going to look at some of the channels for global transmission. The trilemma, which is throughout the paper, but you didn't explicitly mention, we just make that clear. Talk about the fact that this is really the dollar. It's not foreign credit. It's a particular role the dollar has in the financial system. And then we're going to just go to some of the detailed results that Bob showed. So what they find, if you look carefully, is mixed or weak evidence of transmission of Fed policy into policy rates in East Asia. Now, they do find really big effects in advanced economy bond markets with weaker spillovers in Asia. And that's really a summary of the evidence. The evidence there is going to be disputed for the next 50 years, so I'm not sure it's worth really arguing about it. The exchange rate stuff is perhaps the most interesting because that's where you get controversy. It's really hard to do. What exactly is driving it? Is it this quantity theory or the Soros graph? Is it something to do with interest rate differentials? What's the policies these countries are following? How substitutable are the bonds? You know, what are the interventions that they're doing? So as I said, I'm going to come back later to the extensive discussion of the dollar credit that they did in East Asia, which I think is the most interesting part of the paper. So here's the Fed's balance sheet, assets and liabilities. And let me see if the colors showed correctly. Yeah. So one of the things that came up earlier is central bank swaps. You see that sort of the medium blue there? And they accelerated. That's the largest single source of lending that the Fed did in 2008. And that's in a form of official liquidity. Jean-Pierre is here, right? This is one of the big things where central banks proved that they could do something good compared to the 1930s. Dollars are very important. And the Fed said it didn't extend the swap lines. It extended it to countries. But what it did is it took the cap off the swap lines. So that meant that you could come as a central bank, swap with the Fed for the big central banks, mainly the euro area, and you could borrow or swap as much as you like with the Fed. So that was a pretty big success. It showed us something about the pervasiveness of dollars through the global economy, and the other way of describing that is global liquidity, I think. And the other thing, just to start on why I don't think quantity is important, is see something called supplementary financing account there? That's the Treasury issuing a whole bunch of bills to help out the Fed and depositing the cash with the Fed. That thing moves around like crazy because of debt limit, etc. You can't see any impact in prices there or in any other kind of flows. So that's the first one. Let's do a sort of similar chart to the one you showed, which is central bank security portfolio sizes as a share of GDP. And what I've done is I've taken forecasts for the Fed from the primary dealers, so it's a private group doing that, what the Bank of Japan says it's going to do. I've assumed the ECB doesn't access the OMT, and then the Bank of England is reinvesting their portfolio. So you can see one of the big moves that's going to happen is the Bank of Japan is going to have this massive expansion. Now, I don't think that's the best way of measuring it. You want to measure it in excess of currency. If you measure it in excess of currency, you see how the Bank of Japan at the end of 2012 had very little assets in excess of currency and will come to the highest level after that. Now, when I look at these type of charts, I know this is going to happen, but it turns out it's got nothing to do with the flow, or it doesn't look like it has much to do with the flow. It's the prices that are really moving things. Even having said that, because I'm here, we got together and did this big chart of how the flow might work. Now, this is what might happen, and it's the case that, and we're going to see in a minute, that countries with dollar foreign exchange reserves didn't really take on this particular opportunity. Now, if they had, right, you would have had portfolio rebalancing within those countries. Again, the real strength of that is going to be through the price effect, which, if you have color, you can see I've put in red. But this tries to capture what people talk about portfolio rebalancing. I'm not going to have time to go through it, but it's in the packet there. All right, so who did the Fed actually buy these from? There's a new working paper that tries hard to find this out. Remember, when the Fed sells, it sells to it buys from primary dealers. We don't know where they source those securities from. So using the flow of funds, Seth Carpenter and some staff at the board try to work that out. And what they found through estimation, that's why you can see negative stuff in here. It's not really negative, it's just an estimated number. What they found is most of it is coming really from the US, which sort of makes sense because the whole idea of the policy we're going to see the next one is to take interest rate risk onto the Fed's balance sheet. So the people who are going to have to absorb that interest rate risk later on are the people in the US. So expect them to do the trade more. And remember that half of outstanding treasuries are held outside the US. So the rest of the world wasn't contributing too much to this in that line there. All right, so the way we like to think of what the Fed's been doing is not necessarily quantitative easing in the way that people think of it, but taking duration or interest rate risk out of the market. So this chart here shows you the weighted average maturity of the sovereign debt market across the US, Japan, Europe, and the UK. What the WAM is of the portfolio end 2012, then again taking a forecast of what it might look like at the end of 2014, and then the weighted average maturity of current purchases. And what you see there is, you see changes at the Bank of Japan. Instead of being short in maturity, they're now buying longer, but it just matches their sovereign debt market. The ECB is a completely different program, the Security Markets Program, so you don't see a wham of current purchases in there, and you see it was pretty short. The Bank of England is a country where the debt that the government has is really long maturity, and they just bought across that yield curve. The US is pretty unique in what the Fed did, is it took a lot of duration out of the market. Again, took this interest rate risk onto its balance sheet. Okay, so here's the policy trilemma. I'm not an expert in international economics. We've got one speaking soon, hopefully. So here you can basically choose two of these three corners. And a lot of what we saw in Bob's discussion is countries having to abide by that. There was a paper by Klein and Shambo, I think at the Bank of Japan conference, trying to think about all the efforts to round the corners that countries do, and that's sort of what you were talking about there. All right. So this I thought would just be useful. I took this from someone else's work. I'm not an expert in this. Just to emphasize why global liquidity is very much related to the dollar and what the Fed does. A lot of countries either dollarize, peg, or manage a float against the dollar. So it's about 52% of countries in that line 5. And if you ask yourself the share of foreign GDP, so that's excluding the US, in 2010 it was 36%. So this number is going to be higher now because China and East Asia keep on growing. And that's excluding the US in there. So a lot of the world economy is integrated with what's happening with the dollar. All right, so one of the great things Bob's been doing for how many years now? Looking at offshore dollar credit growth. And one of the fascinating things is a lot of offshore dollar credit growth doesn't seem to have anything to do with the United States in any way. That's the work you've been doing recently. And that's one of the themes that comes up in this paper. They do a vector autoregression analysis, and this seems, it's all driven by China. It's got nothing to do with the US. That was my reading of it. There's a little bit in there, but remember, whenever you put the US into a regression or a VAR, and you don't have other global variables in there, you've probably got, it's absorbing a lot of what other variables will be explaining you just by putting the US in there. So one of the things we thought when we looked at the paper is be useful to have seen it for other countries. I assume you didn't have the data, so you couldn't do it. And what you'd like to know is something about capital controls, macroprudential tools, or really what are credit controls. So this is really what you call them macroprudentials, but they're credit controls, I think, in the way they've been used. We'd also like to know some about international trade. That's a big part, I think, of what's happening in Korea, and particularly international trade in banking services. So I'm going to talk about that in a minute, but that's a very understudied area, and we need to know more about that to understand what global liquidity is. It's like Tom Sargent's talk. How exactly do banks work? What is liquidity? When we see across countries, what is the technology that they're using there? And then we want more on the cross-country spillovers in there. So just to finish off, what we see, I think, right now is these global firms and global banks. They're trying to facilitate lower cost of capital controls. That's one of the themes there. So the banks located in Hong Kong are serving China, and it's a crucial question about how effective they are at reducing the capital controls, because given the trilemma, that's going to have really big implications. And then the other thing that Bob mentioned is there's this rise in debt security issuance in dollars. So that's clearly one means of hedging, but it could be used to access in external funding pools. And what you see is Korean firms trying to shift away. So they're shifting away from some form of financing because of the macroprudential controls into these international debt markets. And just to finish off, I think that we need to understand the technology a little bit better here. So Benoit talked a lot about risk sharing, which is endowments, but it's the technology of international banking and global banking that would be useful to know about. I'll give a call out to a paper from someone we had at the New York Fed, Federica Nietman. who's tried to take the Mellitz model and apply it to global banking. That's the end of my thing. Did I get there for 10 minutes?
This makes me feel bad, Simon, but again, the idea is that we can also get some other questions in. Thank you very much. So we move to the next topic. Jonathan, the floor is yours.
Terrific. Well, thank you very much, Fritz, and thank you to the Bank of Korea for organizing this splendid conference and for inviting me to speak at it. So my talk is going to key off the fact that we have observed since the financial crisis in particular a huge increase in the volatility of capital flows. And this has given rise to a bunch of multifaceted policy responses around the world, particularly emerging market countries. And I want to offer some proposals for how these different policy responses might add up, some kind of rules of the road for these different policy responses. And I should hasten to add at this point that the views are my own and not of the IMF. So there is clearly a widespread perception, and this is the link to this conference, that easy money policies, ample global liquidity, if you will, have been fueling high and volatile capital flows to EMEs. Not just to EMEs, but to some advanced countries as well, notably Korea. I would note that capital flows seem to have rebounded considerably and are now at levels that we saw at the peak of the boom before the crisis, though there's a lot of cross-regional variation. And there is growing evidence. Benoit talked about some of it this morning, the Fracture paper, but there are a variety of papers coming from the ECB, my own institution, the Fed, that suggest some connections between quantitative easing, either announcements or the actual purchases, and reallocation of portfolios, capital flows to non-QE countries with open capital accounts. Whatever one's views about these connections, the fact of higher volatility and the need to manage that volatility is very evident. Here's a picture that you'll be familiar with of bond and equity flows that documents the higher volatility since the crisis, actually a bit before. And here superimposed on that are the episodes of large-scale asset purchases, QE1, 2, and 3. And I think there's some evident associations that are clear in the graph. My colleagues who have worked for a long time on boom-bust cycles in capital flows have suggested to me that these cycles are becoming more, not less evident and virulent over time. They envelop more countries and they are involving higher inflows on the way up and higher busts on the way down. And not surprisingly, these episodes, generate a number of different risks, which I think it pays to sort of divide into macroeconomic risks, which are centered on the exchange rate and also inflation, as well as financial stability risks, which are centered on credit growth and especially FX credit growth. And not surprisingly, these different risks have elicited different policy responses, macroeconomic policies, current policies to stabilize the exchange rate through FX intervention, macroprudential policies, and of course, capital controls. So, as I said, I want to talk a bit about how these different policy responses add up in a multilateral way, but I need to say a little bit about sort of the policy decision tree at the country level. And the way I think about it is you have your macroeconomic risks down the left-hand arm of this. And what is important is that, and this is sort of consistent with the institutional paper we put out a few months ago, that to the degree that they are generating macroeconomic risks, you want to ensure that your macroeconomic policies are in line with their primary targets, so monetary policy with inflation, fiscal policy with debt sustainability, and so forth, and especially that your exchange rate is at a multilaterally consistent level. And you want to ensure that that is the case before you consider introducing capital controls, because otherwise, essentially, you are running a kind of a beggar thy neighbor policy in the sense that your capital controls would be supporting an exchange rate that was not multilaterally consistent, was not desirable from a multilateral point of view. Now, things are a little bit different when one thinks of capital flows generating financial stability risks. In this case, there's no particular reason that you hold back from either introducing macroprudential measures or capital controls before you pass some exchange rate test. Essentially, you want to safeguard the stability of the financial system and use whatever instruments are effective and have traction against those financial stability risks, whether or not your exchange rate is at a multilaterally consistent level. And so I think there's a fundamental difference about sort of the ordering of when you introduce capital controls. Staying on the topic of financial stability risks, for me, the key distinction about whether you use macroprudential tools or capital controls really depends on whether the flows are intermediated through the regulated financial sector. If they are, then I think your first port of call would be macroprudential tools, and they should be tailored to the specific risks at hand, be it maturity risk, currency risk, credit risk, risk of asset price booms and busts. However, when the flows are not intermediated through the actually or potentially regulated financial system, I think it's safe to assume that prudential policy is going to have very little traction at mitigating against the associated risks. And so you're more likely to turn to capital controls, again, tailored to the specific risk at hand, which fall into broadly the same buckets as before, rather than prudential policy, which by definition is policies that are geared to the financial sector. Now, it's not surprising that given the proliferation of these different policies that have been introduced over the past several years, that there have been many calls for coordination. The G20 has been very vocal on this issue. My former boss, Raghu Rajan, has worried a lot about the fact that these measures may be forcing adjustments that are undesirable onto other countries. And the IMF has also worried that sort of if these kinds of measures get out of hand, they can accelerate the kinds of trends that Benoit talked about this morning in terms of financial deglobalization and backtracking on the benefits from financial integration. So what are the key multilateral issues of concern? Well, for me, it helps to think of them as falling in a few categories. One is that capital controls or similar measures may actually substitute for warranted external adjustment or macroeconomic adjustment. A second issue is that capital controls may deflect flows to other recipient countries. This is something that the paper Bubble Thy Neighbor by Kristen Forbes and colleagues has talked extensively about. A third, of course, and this is the elephant in the room in terms of the discussions that have taken place so far, is the spillovers from source country policies. And so basically in all of these cases, the question that we need to ask is, in the presence of these spillovers, what is the implication for the country pursuing the policy? Should his course of action be circumscribed in some way? And what is the scope for coordination? So these issues actually have been around for a very long time. They were debated at the time of the founding of the Bretton Woods institutions. They were talked about, as Tom and I were discussing yesterday, they were even talked about in Harry Dexter White's PhD dissertation at Harvard in the early 30s. Both Keynes and White felt very strongly that the solution to the problem of managing capital flows really rested on attacking the issue at both ends, both source countries and recipient countries. And so this is a very old issue that, of course, has found resonance in more recent times. And it's you know, to me wasn't surprising to hear some of these voices that are quoted here, especially from the Brazilian authorities and the Korean authorities, who have also been vocal on this issue. But of course, where you stand on this issue depends a little bit on where you sit, and it's interesting to me the reaction of the Indian authorities in the wake of the announcement of QE3. Basically, the idea being that they would welcome additional flows given their financing needs. So, you know, we might ask, you know, to what extent empirical evidence is a good guide for policy here. And my bottom line is that it is helpful, but it is not decisive. The unilateral evidence on capital controls is relatively mixed. And it is interesting that one of the themes is that capital controls seem to have stronger effects on the composition than on the aggregate level of inflows. But to the degree that the aggregate level is not affected, then to me there would be little reason to circumscribe their use multilaterally, since the spillovers would depend largely on having an effect on the aggregate level. There is some emerging evidence on spillovers. There's Kristen Forbes' paper, which I mentioned earlier. There's some work by colleagues at the fund. And there's important work by Olivier Jeanne on the issue of capital controls substituting for external adjustment. There's a much older and I think more persuasive literature on spillovers from source country policies, which goes back to Calvo, Liederman, and Reinhardt from many years ago. But my bottom line is that we're going to have to rely sort of more on economic logic than on the empirical evidence to make headway here. So I would see that there are kind of four multilaterally relevant cases. One I'm going to go over very quickly because implicitly in the flow chart, I have already dealt with it. It basically is pointing out that the use of capital controls, which substitutes for warranted external or macroeconomic adjustment, is multilaterally problematic. So I would want any rules of the road to rule out the use of capital controls in such situations. So that leaves three different cases that I want to talk briefly about. I'm going to focus on the middle one of these more extensively. So the first one is terms of trade manipulation. I'll explain a little bit what I mean. The second is financial stability externalities, and the third is production externalities. So why do we even think about terms of trade manipulation? I mean, basically, it's by analogy with the goods trade case. The idea is that a country can manipulate its intertemporal terms of trade, the world interest rate, by restricting either inflows or outflows. And basically, this is multilaterally problematic for the same reason that this would be multilaterally problematic in the goods trade case. There's no country-level distortion that would justify the diminution of the volume of intertemporal trade in financial assets. And therefore, there's no global efficiency reason to to condone the use of capital controls for terms of trade manipulation. Now you might say, what on earth are we speaking about terms of trade manipulation here for? It really doesn't resonate at all that a country would impose capital controls to manipulate world interest rates. I would agree it does sound a bit far-fetched, but I would ask you whether you can think of any net creditor nation that has significant controls on outflows, or whether there are any net debtor nations that pursue policies that might have a material effect in terms of lowering the world interest rate. So it is far-fetched, but I wouldn't rule it out of hand. The second case is financial stability externalities. And this is the case that's received the most attention in the literature. It's the case where there is, a genuine domestic financial stability distortion associated with foreign borrowing, and a Pigouvian tax type of response to that would justify the use of capital controls. And of course, such controls will have spillovers. And what I want to investigate a bit further is whether these spillovers are problematic from a global efficiency point of view. I think oftentimes we jump from the existence of spillovers to the existence of externalities, and I want to suggest a strong difference. So at this point, I'm just asking you to hold the thought that there are these spillovers, to think of them as pecuniary externalities, in much the same way that if I restrict my demand for coffee, there will be effects on coffee producers and coffee consumers that is not necessarily problematic from a global efficiency point of view. I want to mention briefly production externalities, and to say again that here the use of capital controls to me is somewhat problematic. When there is a production externality, you would think of using production subsidies as the first best response. There are situations where there might not be the budgetary resources for such subsidies, or alternative taxes might be ruled out by trade agreements. You might be trying to tax the non-traded sector also, for example, but that may be informal and easily escaping the tax net. So you might turn to a policy of undervaluation supported by capital controls. My sense is that this would rightly invite multilateral scrutiny for at least a few reasons. First of all, it is not the first best response. Second of all, it has larger spillover effects than the first best response because it distorts consumption as well as production decisions. And third, it's very difficult to verify in practice whether a country is putting in place capital controls to offset a genuine production externality or is merely claiming to do so. So I want to come back to the use of capital controls to offset financial stability externalities. And I want to make the claim that, in the kind of setup that I've introduced so far, the existence of these spillovers is not harmful at all from a global efficiency point of view. Essentially, the imposition of controls may deflect flows to other countries, but here the Nash equilibrium is going to be perfectly efficient. We're in a world where there is one target, which is to offset this financial stability externality, and one instrument, namely the capital controls. And in this one target, one instrument world, a country that experiences these spillovers is going to be able to perfectly offset them with their one instrument. Now, things are more complicated when you think of capital controls as being costly. And you know, how you want to think about these costs is your choice. There are, of course, bureaucratic and administrative costs, but I like to think of these costs more in terms of imperfect targeting of the flows and the collateral damage that can be that can accrue when you impose capital controls. So you may be wanting to target the hot money flows that are giving rise to the financial stability externality, but you may end up targeting a broader array of flows that you don't want to target. And so here, the Nash equilibrium is not going to be globally efficient. Intuitively, I will overestimate when I impose capital controls the net benefit, because I will deflect, and in the symmetric Nash case, you will impose controls and deflect back to me. Essentially, what is going on is that you have two targets here. You have the financial stability externality and the cost. And so a global planner will be able to get at a more globally efficient equilibrium than will two countries fighting a capital control war, and will generally scale down the extent of the controls. And when costs are convex, the main difference is that to get to the globally efficient outcome, you will need to involve the source countries as well. And this is very much at the heart of Keynes's and White's idea that you needed to operate at both ends of the transaction. So to get to global efficiency here with convex costs, it's important that you are able to bring the source countries to the table. And the question is how you do that, because it's not immediately obvious what the incentives are. We offer a few suggestions in the paper. There's a terms of trade gain. That's one of the reasons I mentioned the terms of trade case at the beginning. Essentially, when the source country restricts outflows, it enjoys a terms of trade gain. There may be also the risk that a financial crisis in the recipient country will blow back to the source country, and there may simply be a sense that the source country is pursuing policies for the global public good. So I want to offer four tentative rules of the road, as it were. The first is that capital controls should not substitute for warranted external adjustment. The second is that they shouldn't be used to exploit market power. And the third is that when they are imposed to offset genuine domestic financial stability externalities, there may be a need for coordination, for instance, when there is a surge in flows to a broad group of recipient countries, and there may be a tendency in the costly capital controls, which I think is the realistic case, for a capital controls war. And also there may be a need, which I think is probably the most important consideration here, for coordination between source and recipient countries. But the issue is really the incentives to the gains from trade, as it were, for both source and recipient countries, since the existence of such gains from trade is a prerequisite for coordination. So to conclude, maybe I'll leave you with one thought, which is that this paper has focused on coordination really across recipient countries and only to a very limited extent with source countries. I think a companion paper, which we are working on, is really going to try and look more at coordination across different source countries, say USA and Japan, and also what the incentives for coordination are in more detail between sort of source countries as a group and recipient countries, and try and offer some additional rules of the road. Thank you.
Thank you very much, Jonathan. Olivier.
Thank you for inviting me to this very interesting conference. This chart is showing you something that's relevant for our discussion. On the left-hand side, you have a representation of unconventional monetary stimulus in the US with the Fed funds rate and the monetary base. And on the right-hand side, you have data that comes from the IMF annual report on exchange rate arrangement and exchange rate restrictions, which is the number of measures towards the financial sector that are taken by IMF member countries, some of which are in the direction of easing and some of which are in the direction of tightening, some of which are capital controls because they differentiate between residents and non-residents, and some of which have more the nature of macroprudential regulation. And you see with the crisis a sharp fall in the number of measures that are easing, while the number of tightening measures tends to increase. And one question is whether what we see on the right-hand side could be, to some extent, the result of what we see on the left-hand side, that is, recipient countries, emerging markets, have to take more macroprudential measures because of unconventional monetary stimulus in advanced economies. And this raises the question that Jonathan talked about, which is the question of is there scope for international coordination? Do we see policies that are too extreme, too excessive in some sense, too intense because of a lack of coordination, and should we try to pursue international coordination to achieve global efficiency? Now, I would like to, in my discussion, Jonathan's presentation was very rich, and I would like to focus on, in my presentation, on the theory that might underlie a case for international coordination. Now, in the second part of his talk, Jonathan made some statements that are based on a paper with Rex Ghosh and Anton Korinek, in which you have the beginning of a theory of international coordination of macroprudential policies. And this is all the theory we have at this stage. So in that sense, their paper really breaks new ground. There is an old and venerable literature in international macroeconomics about the international coordination of monetary policies. But there is no literature on the international coordination of macroprudential policies because it has been only for a short time that we are talking about macroprudential policies in the way that we do now. So what is this embryo theory that is underlying Jonathan's statements? Well, it's a model, which is a neoclassical model, basically, with full employment, and in which in each country you could have an externality. So it could be a financial externality, or it could be a production externality, as you said. And this externality can be addressed by a domestic policy, a tax, a Pigouvian tax, that you could interpret as macroprudential regulation. And then they look at the equilibrium, the Nash equilibrium, in the game involving these policies, and they look for inefficiencies. And in fact, it's pretty, so what is somewhat surprising is that it's pretty difficult, even though you have spillovers, international spillovers, in such a framework, it's pretty difficult to find a case for international coordination because essentially each country is a small country, is a little bit like a consumer in a general equilibrium model, all the spillovers are intermediated through a competitive price, which is the global real interest rate. And because of that, the first welfare theorem applies, and you have something that you might want to call pecuniary externality if you want to, but it's not a true externality, and there is no case for international coordination. So what I would like to do in my talk, so one limitation of the model also is that it focuses on macroprudential policies. So there is no monetary policy, so you cannot study the interplay between monetary policy and macroprudential policy at the domestic level or across countries. And clearly for our discussion, I think we feel that we would like to move in that direction. So I don't have the model either, and what I'm going to do in my discussion is give you speculations and maybe questions that arise, I think, when you try to develop such a model. So I'm going to talk about source countries and recipient countries, and here my definition is essentially the same as Jonathan's. And I'm going to look first at the case for coordination between one source country and one recipient country, and then between source countries and then between recipient countries. But I will focus mostly on the first kind of coordination. Now, let's start with the textbook view of international adjustment under floating rates. So what do we mean by a source country here? Well, we could say a source country is simply a country that has a negative demand shock and needs to stimulate its demand. Now, the textbook model with nominal stickiness and a high level of exchange rate pass-through is going to say what? It's going to say that the source country should lower its interest rate. That's going to depreciate the exchange rate of the source country, and the recipient country is going to also lower its interest rate, but less than the source country. So in equilibrium, there will be an appreciation of the currency of the recipient country that will be associated with the flow of goods and of capital from the source country to the recipient country. That is, some of the demand for the source country goods will come from the recipient country. And this is part of the adjustment. And one big lesson from the modern literature, international macro, is that in a setting like that, there is no very good case for international coordination. That is, if countries do their adjustments in an uncoordinated way with floating exchange rates, we go to, or pretty close to, an efficient equilibrium. So what is the gap between this textbook model and the world that we live in? So I would like to focus on two gaps. The first one is the fact that now we are saying that the recipient country should worry not only about its macroeconomic objectives, like full employment, it should also worry about the systemic risk that comes with the capital inflows from the source countries, the source country. And here, the recipient country can use a range of policy instruments going from domestic macroprudential regulation, so for example, the levy on bank wholesale funding that Korea introduced in 2011, prudential capital controls, for example, the kind of measures that Brazil has used since 2009, and I would add too foreign exchange reserve accumulation, which coupled with capital controls could be also a very effective way of changing the composition and the quantity of capital inflows. Now, there is no real continuity between these different measures. That is, if you look at one measure, you could say that the tax rate could be increased or decreased at the margin. But I think there is a real difference of nature, in particular, between domestic macroprudential regulation and prudential capital controls. And one reason is that you can have very targeted macroprudential regulation, like the Korean measure. It's very difficult to have very targeted capital controls because they tend to be circumvented. So capital controls tend to become very broad, and the Brazilian experience illustrates that. It was a tax on all capital flows except FDI. Domestic macroprudential regulation is closer to the first best instrument than prudential capital controls. Now, these instruments also have very different impact on aggregate net flows and the demand for source country goods. It stands to reason that a measure like the one Korea introduced in 2011 should have an impact on the composition of capital inflows, but probably will not have a lot of impact on the size of capital inflows, on net aggregate flows. It's less clear for prudential capital controls. And it's even less clear when you have prudential capital controls or capital controls and large accumulation of foreign exchange reserves. Now, it matters for the source country because remember, accepting capital inflows for the recipient countries is a way of stimulating the demand for the source country goods. So rejecting these capital flows has an externality on the source country, which is a Keynesian demand externality, and an externality which may not be internalized by the recipient countries when they design their capital account policies or their macroprudential policies. I think it's a very important externality to have in mind when we think about the case for international coordination of prudential capital controls in particular. Now, how does the world differ from the textbook analysis? Well, the other important way in which it does is that the source country can no longer lower its policy interest rate at the zero bound. And so the source country is going to use unconventional monetary stimulus. Now, in our discussion, we tend to identify unconventional monetary stimulus with quantitative easing. But I would like to note that in the theoretical literature on the zero bound constraint and the liquidity trap, in fact, there is a discussion between different kinds of monetary stimulus, quantitative easing being one, but also forward guidance, and making an announcement about the future path for the interest rate, or raising the inflation target, as Japan did. It's not all, so there are different flavors of quantitative easing, but it's not all about quantitative easing. Now, the way the source country does its unconventional monetary stimulus might matter for how risk-creating the capital flows are for the recipient country. It could be, for example, that quantitative easing, because it introduces, it has an influence on stocks, on balance sheets, and introduces a large stock of liquidity, affects recipient countries differently from forward guidance. And this is something on which I have a little to say, except that we would like to know much more than we do about that. Now, for the sake of the argument, and here I'm just making up numbers, I'm showing you an example of prisoner dilemma between a source country and a recipient country. So the idea is that the source country could do forward guidance or quantitative easing, and that the recipient country could do targeted macroprudential regulation or broad capital controls. And I just put numbers, and these numbers reflect the view that each country would like to use maybe the more aggressive measure, but it has a large externality on the other country, right? So the source country would like to do quantitative easing, but it's going to have a large negative impact on the recipient country, much more than forward guidance. So here, there is a case for coordination. The countries should coordinate on forward guidance and targeted domestic macroprudential, the Nash equilibrium being quantitative easing and broad capital controls. Now, one point I would like to make in connection with this table is that, I mean, there are two ways of thinking the case for international coordination. So we could say the source country is going to do quantitative easing a little bit more, a little bit less, and the recipient country is going to apply its Pigouvian tax a little bit more, a little bit less, and then there's an equilibrium in which the tax could be a little bit too high and that could be a little bit too much quantitative easing. Now here things are a little bit different. When you go from the coordinated equilibrium to the uncoordinated equilibrium, you have a change in the way the international financial system looks, right? There is a discontinuity here. There is a change in the structure because we are going from a situation where countries have targeted macroprudential measures to a situation in which countries, all recipient countries potentially, would apply broad capital controls, and then we would have a kind of financial disintegration of the type that Benoît Cœuré was talking about this morning. So I'm not sure which is the right way to think about the real world. Clearly, the case for coordination would be stronger, more pressing, more compelling if we thought that coordination would be a way of avoiding undesirable change in the structure itself of the international financial system. Now, there could be prisoner dilemmas between source countries. So I could assume, for example, that if both the US and Japan adopt quantitative easing, the pressure on recipient countries is so large that they are all going to adopt capital controls. But if it were only the US or Japan, then they would adopt lighter measures. Then there would be a coordination problem between the US and Japan if they want to adopt quantitative easing. Or there could be a prisoner dilemma between recipient countries if the fact that all recipient countries implement broad capital controls reduces the demand for the source country's goods to a point where the source country has to implement costly quantitative easing, then there would be the same kind of free riding problem between recipient countries. So to conclude, I think that it's a very interesting area of research. It's really a new question, so there is a lot of work to do. I'm not sure that at this stage we have the range of models that would allow us to be confident in the kind of policy recommendations that the little theoretical analysis that we have would suggest. But I really enjoyed very much this paper by Jonathan, Rex, and Anton. And again, I think it is an important first step in the analysis of these questions. Thank you.
Thank you very much, Olivier. Quick chance for both of you, Bob and Jonathan, to respond.
Thank you, Simon, for your comments. I'll just comment on the question of whether the activity in Hong Kong with Chinese companies borrowing dollars in Hong Kong, whether that amounts to undermining the capital controls. It's a very interesting process where Chinese companies take their domestic deposits, in effect part of M2 in China, and pledge those with a bank and get a letter of credit in Hong Kong and draw down dollar credit. So money behind the capital controls becomes credit out in the international marketplace. And I guess the evidence so far, while this is apparently quite lucrative business, it doesn't go so far as to represent a big change in the capital controls, which still seem to bind by any number of measures. I would like to venture a comment, if I may, on Olivier's presentation just now. He drew a distinction between forward guidance and QE as different kinds of measures. I mean, taking Simon's view on the quantitative easing is really taking duration out of the market. Then both forward guidance and bond buying have the same result, which is lower, say, 5-year note yields. And indeed, there's some argument in the literature, people ascribing portfolio balance effects or forward guidance effects. But they amount to the same thing, it seems to me. And I think it's important to keep the range of possible responses in mind. In particular, a recipient country could, through changes in debt management, remove duration from its own bond market and essentially fight fire with fire. When central banks are buying bonds, they've lost the monopoly of their instrument. They're sharing that instrument with the debt managers, and the debt managers in the sort of target economy can put downward pressure on their own bond yields through the mix of shifting the mix of their own funding operations, sort of in the government.
Thank you, Bob. Jonathan?
Well, thank you very much, Olivier. I really appreciate your comments and very, very incisive. Maybe I just make 2 points. I meant to make this point this morning, and I hope I'm not misquoting Benoit Cœuré, but I think I heard him say, and it's related to Olivier's comments, that he hoped that recipient countries would not use capital controls or similar measures too strongly. So I think it's important here to have the perspective that there are both source and recipient countries in this game, and that the gains from coordination really speak to both countries, both the source and the recipient countries, giving up something for the sake of global efficiency. So if one hopes that the recipient countries will not use their measures too strongly, one also has to hope, given the spillovers from source countries, that they too will not use their measures too strongly. And I think that speaks to the prisoner's dilemma matrix that Olivier put up. I slightly disagree with you, Olivier, on whether there's a baseline case in the standard macro model with floating exchange rates, assuming there are the usual frictions that make this an interesting discussion. I mean, the case for coordination depends on the sign of the international transmission of the policy. So in general, if we have two symmetric countries, the US and Japan, and they're both easing like crazy, there will be a case for coordination as long as there is a definite sign to the international transmission. So in this case, there's an exchange rate effect and an output effect. If one dominates the other, then either monetary easing by the Fed or Japan will be a global public good or a global public bad, and the planner will. So a slightly different thing. And my last point is that this idea of whether you can target a capital control or a macroprudential. I mean, I think de facto a lot of what I hear is involved in the bank levy of non-core liabilities in Korea. I mean, given that most of these funds are sourced abroad, even though de jure it's not a capital control, to me it seems to be operating like a capital control. And in fact, as you pointed out, it's targeted, so it's a targeted capital control. De facto, even if de jure, for the reasons you said, it isn't.
Thank you, Jonathan. I'm sure the organizers will allow a couple of questions. We started slightly behind schedule, so without unduly going into the coffee break. And we've been eating way too much anyhow, so I think, please.
I guess this is a question for Jonathan, and maybe for Olivier as well. I mean, in terms of this discussion of the scope for coordination between the source and recipient countries, I think you have to be realistic about the asymmetry in size between the economies that we're talking about. So to the extent that the source countries are targeting their monetary policies for primarily domestic concerns, the degree to which the recipient countries can help the source countries out through their actions is rather limited from the source country's point of view relative to their domestic macroeconomic concerns. And so I really don't see much scope for very large source country economies to really be induced to cooperate with the recipient countries from the point of view that the recipient countries would in turn agree not to levy capital restrictions.
Who would like to answer? Jonathan?
Yeah, I'm not sure I have a ready answer for you. Size is clearly one factor. You know, I think if the issue is the transmission of, say, U.S. monetary policy to Mauritius, you know, is there a lot that Mauritius can give to the U.S.? I think the answer is probably no.
Anybody else daring to push out the coffee? Please, thank you, Akito.
So it's actually related to Mark's point, but we want countries should not seek exploit market power, but is that kind of possible that for, let's say, U.S. not taking advantage of their position of their reserve currency, they can print more, or these market power in many respects. How let's say IMF can persuade the U.S. policy maker to kind of think about globally.
All yours.
Again, just a thought on both Mark and Akito. I think when we're thinking about a possible rule of the road here, it might be of the nature that a country can do what it needs to do for internal balance, provided, say, what I think is the key transmission channel, the exchange rate, does not get too far out of whack. So basically the issue is, the exchange rate channel is the source of the negative spillover to somebody else. So you can ease as long as your exchange rate does not get 10 or more percent away from its multilaterally consistent equilibrium. I think that there's sort of a consistency, a symmetry between the monetary policy point here and the capital controls issue. Again, it's sort of substituting for warranted external adjustment, the idea being that if you get too far undervalued, then it's problematic from a multilateral point of view.
Thank you very much. I'll stop here. Thank you again for letting us continue, and I think our panel and the discussants have earned a round of applause. Thank you very much.